Most traders lose not because their strategy is bad, but because their mindset is. You can study supply and demand trading strategy, market structure forex trading tutorial, higher time frame forex trading, or even the ultimate guide to market mechanics, and still struggle if your psychology is not aligned with execution. The truth is simple. Trading is not only about charts, entries, or indicators. It is about successful trader psychology. The market does not beat you. Your emotions do. That is why psychology sits at the core of every trading masterclass full course. Whether the focus is market structure in economics, how to trade smart money concept, or any closing price trading strategy. This is the only trading psychology video you need to understand how mindset directly affects performance. It is a complete trading psychology course, structured as one single journey and divided into clear chapters. And it will be delivered in 2 parts. Part 1 includes these chapters: the trader's mind as your worst enemy and greatest ally, the 3 brains of trading, cognitive bias and self-deception in trading, fear, greed, and discipline, patience, and consistency. Part 2 continues with these chapters: trader identity, risk and reward part 1, risk and reward part 2, emotional management of losses, routine, preparation and mental performance, trading journal and feedback loops, and conclusion. Building your personal trading psychology framework. This course does not replace technical knowledge. Instead, it connects psychology with execution. Whether you trade using a binary trading strategy, smart money concepts, or classic market structure models, your results will always depend on how well you manage risk, emotions, and consistency. This is not motivational content. It is a practical psychological framework designed to improve execution, reduce emotional mistakes, and support real decision-making in live markets. The journey begins now with part 1 and the first chapter. So if you enjoyed this video, make sure to like it, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now it's time to begin with the first chapter, the trader's mind as your worst enemy and greatest ally. Have you ever broken your own trading rules and regretted it moments later? Most traders do not lose because of their strategy. They lose because they are not aware of how their own mind interferes with execution. Your biggest enemy is not the market. It is your own reactions, impulses, and expectations. At the same time, that very same mind can become your greatest advantage once you understand how it works. In this chapter, you will learn how internal conflicts, emotional habits, and unconscious patterns influence every trading decision. You will also learn how to turn those patterns into tools for consistency and control. As explained by Mark Douglas, successful trading is not about certainty. It is about thinking in probabilities. And that shift in mindset is the foundation of everything that follows in this course. Let us begin with the first chapter. So let's begin with the first truth. The market itself is neutral. It doesn't care if you win or lose. It simply moves. Yet inside your mind, every tick feels personal. Every red candle feels like a threat. That's because your brain was never designed for trading. It was designed for survival. When money is on the line, your mind interprets risk the same way it interprets danger. It reacts as if you are facing a predator. And this is why you often don't follow your own plan. You hesitate to take the entry, you exit too early, or you jump into a trade out of fear of missing out. It's not because you're undisciplined, it's because your brain is trying to protect you. But in trading, that protection becomes sabotage. There's another trap too, the illusion of control. Traders crave certainty. They want to know exactly what will happen next. But markets don't offer certainty. They only offer probabilities. And when you demand certainty from an uncertain game, frustration and mistakes are guaranteed. Think about it. How many times have you said, I'll just wait until it feels safe, only to miss the move? Or told yourself, this one has to win, right before a big loss? Those are emotional decisions dressed up as logic. The truth is, we don't lose to the market. We lose to the stories and fears our own mind creates when faced with risk. And here's the part most traders never realize. Those stories don't just stay in your head. They show up in your body. When you see a big red candle or your P&L flashing negative, your brain fires a stress signal. Cortisol floods your system. Your heartbeat jumps. Your breathing gets shallow. Your vision narrows, almost like a tunnel. In that moment, blood is pulled away from your prefrontal cortex, the logical part of your brain, and redirected to prepare you for fight or flight. It's great if you're running from danger, but terrible if you're trying to manage risk on a chart. That's why you suddenly click impulsively or freeze when you should act. It's not just a bad habit, it's biology taking over your decision making. And if you don't notice it happening, the body leads the trade, not your plan. That's where the real enemies show up: fear, greed, and impulsiveness. Fear makes you hesitate. You see the setup, but you can't click the button. Or you exit the trade too early, grabbing a tiny profit because you're afraid to let the market breathe. Greed is the opposite. You catch a win and suddenly you feel unstoppable. You add more size, you take trades outside your plan, or you keep pushing long after your daily target. That euphoria feels powerful, but it's a trap. And then there's impulsiveness. You're tired of waiting, so you force a trade. You move your stop. You chase a move that's already gone. Deep down, you know it's reckless, but in the moment, it feels like relief. These emotions disguise themselves as logic. They whisper excuses like, this one looks too good to miss, or I'll just risk a little more. But in reality, they're the same saboteurs draining your account over and over again. The worst part? These behaviors don't always come from massive mistakes. Sometimes it's just a small decision, moving a stop by a few ticks, adding one extra position, ignoring a checklist once. But over time, these small cracks destroy consistency. And here's the good news. The same mind that sabotages you can also become your ally if you train it. It starts with simple pre-commitments. Writing down your rules. Having a checklist of 3 to 5 conditions you must see before you take a trade. When the rules are on paper, you're not negotiating with your emotions in real time. Next is normalizing risk. Instead of thinking, I can't lose this trade, you define a fixed amount you're willing to risk every time. 1 hour per trade. That way, a loss is not a threat to your survival. It's just part of the game. You can also use if-then plans. For example, if I feel afraid to click, then I pause, breathe for 60 seconds, and read my checklist again. By creating these mini protocols in advance, you take back control when emotions rise. Another key is routine. A clean workspace, only the alerts that matter, and one short focus ritual before the session. Even something as simple as 2 minutes of breathing. These habits tell your brain, I'm in control here. And finally, feedback. Keep a journal where you don't just record the trade, but also how you felt before, during, and after. Over time, you'll see patterns in your emotions just as clearly as patterns in price. This is how you start turning your mind into a trading partner instead of an enemy. This isn't just theory. Let's bring it to real trading moments. Picture this. You enter a valid setup, but fear kicks in. The candles start to move against you and you exit early with a tiny profit. Seconds later, the trade takes off in your direction. The setup worked, but fear cost you the reward. If you had trusted your plan instead of your emotions, the outcome would have been very different. Now let's flip it. You catch a big win. You feel unstoppable. In that rush of euphoria, you take another trade and another, pushing past your daily limit. By the end of the session, not only is the win gone, but you're in the red. That wasn't your system failing. That was greed taking the wheel. Mark Douglas warned about this in Trading in the Zone. He said the market doesn't care about you. It doesn't punish or reward. It simply moves. The only variable is how you respond. If you think in probabilities, every trade is just one of many in a series. No single win or loss defines you. That's the mindset shift. Treating the market as neutral while managing yourself as the real challenge. Now it's your turn. Here's a simple exercise that can change the way you see your own trading. I want you to look back at 3 trades where you lost money. Not because the setup was bad, but because your emotions took control. For each trade, just write down 4 simple things. First, what was the setup and what rule were you supposed to follow? Second, what emotion showed up in that moment? Was it fear? Was it greed? Maybe impatience? Third, what did you actually do that broke your plan? And finally, what did that mistake end up costing you? Then, create one simple if-then plan for each. For example, if I feel fear before clicking, then I will pause, breathe for 60 seconds, and check my rules again. This exercise is powerful because it shows you the patterns behind your mistakes, and once you can see them clearly, you can start to change them. If you'd like to go even deeper on this topic, I highly recommend the book Trading in the Zone by Mark Douglas. It's one of the best resources ever written on how psychology shapes trading results. Now we move into the second chapter. The three brains of trading: instinct, emotion, and logic. In this chapter, you will learn why survival instincts and emotions often overpower logic, and how to recognize which part of your brain is in charge when you trade. We will use neuroscience concepts and insights from Brett Steenbarger to explain how the instinctive brain, the emotional brain, and the logical brain each influence your decisions. Once you understand these three brains, you can start shifting control back to the one that supports consistency, the logical brain. Let's start with the oldest part of the brain, the reptilian brain. This is pure instinct. Its job is to keep you alive, fight, flight, or freeze. In trading, that survival instinct kicks in whenever you see sudden danger. A sharp drop on the chart, your PNL flashing red. Instead of calmly following your plan, your reptilian brain shouts, "Get out now, protect yourself." That's why you might exit trades too early or avoid pulling the trigger at all. The reptilian brain isn't interested in probabilities or edge. It only cares about survival in the next second. Great if you're running from a predator. Terrible if you're trying to follow a trading system. As trading coach David Paul explains, we can actually see this reptilian brain in action in everyday life.
We've got two brains. I'm sure you've all heard of the reptile brain and the front lobe brain. Well, I want you to think now, folks, that you're a summer's afternoon and the barbecue's going and kids are having fun playing football, right? And you're standing there. A ball comes out of nowhere. Football comes out of nowhere. What do? Duck. Yeah? Without thinking about it. Similar situation, but standing there Sunday afternoon and somebody throws a ball at you very slowly. What do? You catch it. Okay. So if somebody chucks a ball at you really fast, believe it or not, and according to this professor of psychology at UCT, there's a part of your brain that actually reacts, and it reacts up to half a second faster than your normal brain, this reptile brain, and its job is to keep you out of trouble. And frequently that happens in our trading as well, where have you ever done something dumb that you've sworn you'll never do again? Okay. And that's because that reptile brain is in fact trying to keep you away from danger. Not the lion about to hit you, but in fact emotional danger. And another example is that you're driving along a road and a dog comes out. Do you swerve? Yeah, you probably do. And you've said to yourself 1,000 times that I'll never swerve again. I'm going to drive straight. But in the moment, that reptile brain. So there's a part of you, if you're not present, folks, there's a part of you that's designed by the Almighty, or whoever you believe in, to keep you safe and well, away from physical danger, away from emotional danger. And if you're not present, you'll find that you keep doing really dumb things. So when you're sitting in your trading desk, it's really important that you're totally and utterly there. Not thinking about the past, not thinking about the future, totally in that moment.
This is exactly what happens when you sit in front of your charts. If you're not fully present, your reptilian brain takes over, and you'll keep doing the same impulsive mistakes you promised yourself you'd never repeat. That's why awareness is everything. The first step in mastering trading psychology is simply recognizing when instinct is hijacking your decisions. The next layer is the limbic brain, also called the emotional brain. This part processes feelings like fear, excitement, anger, and reward. It runs on chemicals like dopamine and cortisol. When you win a trade, your limbic brain lights up with dopamine. It feels amazing. You want more. That's when overtrading and revenge trading show up. When you lose, cortisol spikes, stress takes over, you hesitate, doubt yourself, or chase a bad setup just to get relief. The limbic brain creates powerful urges that feel logical in the moment, but they're not logic, they're chemical reactions. If you've ever said, "I knew better, but I couldn't help myself," that's your limbic brain hijacking your trading decisions. When it comes to the emotional impact of winning and losing in trading, David Paul explains how the body's own chemistry can hijack even the most disciplined traders.
If you've got 100,000 rand in your account, you should not risk any more than 1 to 2% of that in any one trade. And that will keep you alive. But there's a big problem, because we have runs of good ones and runs of bad ones. Now, between your ears, there's a thing called the pituitary gland. And that pituitary gland pumps out muti, that pumps out all sorts of hormones into your bloodstream. And those hormones are actually responsible for every emotional state that you have. When you have one good trade, two good trades, three good trades, the pituitary gland is hard at work, okay? And it's pumping this muti into your bloodstream. And you change completely. What happens is that after a series of winning trades, we become euphoric. And if you look in the Oxford Dictionary, the definition of euphoria is invincible. So just be careful about euphoria.
Emotions can be chemically triggered and feel convincing, but recognizing that doesn't make them any less dangerous. Awareness is your first line of defense. Finally, we have the neocortex, the newest part of the brain. This is where logic, planning, and strategy live. The neocortex is what allows you to design a trading plan, test a system, calculate risk, and think in probabilities. It's the trader's best friend. But here's the problem. When the reptilian or limbic brain gets triggered, blood flow is redirected and the neocortex literally shuts down. That's why you can know exactly what you should do, but in the heat of the moment, you do the opposite. It's not a lack of intelligence, it's biology. While the neocortex gives you logic and strategy, it's useless when emotional circuits take over. In this clip, Brett Steenbarger shows how traders sabotage themselves when their thinking shuts down.
What are the situations that typically set you off? In trading, most of the problem behaviors are problems as the result of under control or over control. Under controlled behavior would be trading impulsively. I suddenly forget about my position limits and I'm trading much larger size than I should be. I'm suddenly not honoring my stops. I know I shouldn't be adding to a losing position, but I keep finding myself doing that. That's an under-controlled behavior. The opposite would be an over-controlled behavior. I'm so anxious I can't pull the trigger and make the trade. My system told me that I was supposed to go long in the morning, and I just sat there and watched the whole damn thing go up and up and up and up. That's an over-controlled behavior.
Your brain knows what to do, but only if you stay calm enough to let it work. Mastering your biology is part of mastering the market. So in every trade, there's a silent battle going on. The reptilian brain wants safety. The limbic brain wants pleasure and relief. The neocortex wants probabilities and long-term consistency. Which one wins depends on how prepared you are. If you don't have a clear plan and routines, instinct and emotion usually take over. But when you've trained yourself to pause, to breathe, and to stick to written rules, you give your neocortex a chance to stay in control. This is why traders say discipline is a skill. It's not about willpower in the heat of the moment. It's about designing habits that keep your logical brain online when instinct and emotion try to hijack the wheel. Imagine this. You see a perfect setup. Your plan says buy. But the last two trades were losses. Your reptilian brain screams, "Don't do it, you'll get hurt again." You freeze, the trade runs without you. Or another case, you just hit two winners in a row. Your limbic brain floods you with dopamine. You feel invincible. You double your size on the next trade and blow away half your account in minutes. Now compare that to when the neocortex is in charge. You lose two trades, but you calmly take the third setup because it meets your plan. Or you win twice, but you still stop after reaching your daily limit. That's logic, not emotion. Brett Steenbarger often says that great traders aren't fearless and they're not immune to emotion. They simply know which brain is speaking and they've trained themselves to let the logical one decide. This week, don't just look back. I want you to observe in real time. The next time you sit at your desk, place a small note beside your keyboard with 3 words: instinct, emotion, logic. During your trading session, whenever you feel a strong urge, hesitation, excitement, frustration, or even calm confidence, stop for 5 seconds and ask yourself, is this my reptilian brain trying to protect me? Is this my limbic brain chasing reward or relief? Or is this my neocortex guiding me with my plan? Put a quick check mark next to the word that matches. At the end of the day, review your marks. You'll see which brain spoke the loudest during your trades. The goal is not to eliminate instinct or emotion. That's impossible. The goal is to notice which voice is leading you in the moment, so you can gradually give more weight to logic. The market will always trigger your instincts and emotions. You can't eliminate them, but you can recognize them and choose not to obey them. The key is awareness. Once you know which brain is speaking, you can decide whether to act or to pause. That awareness is the first step to real consistency. So this week, do the exercise. Review those 5 trades and label the brain behind each decision. You'll be surprised at how much clarity it brings. And if you'd like to explore this topic even further, I recommend the book Thinking Fast and Slow by Daniel Kahneman. It's not about trading, but it explains how our fast instinctive system and our slower logical system constantly compete for control. Reading it will give you a whole new perspective on why we make impulsive choices and how to strengthen the part of the mind that thinks in probabilities and discipline. Now we move into the next chapter, cognitive bias and self-deception in trading. In this chapter, you will uncover the invisible mental patterns that cause traders to sabotage themselves repeatedly. These biases are not random mistakes. They are built into human thinking. And if they are not recognized, they will damage performance no matter how strong the strategy is. By the end of this chapter, you will understand the most common trading biases, how they appear in real decision-making, and how to reduce their influence on your trading behavior. Let's start with one of the most dangerous traps for traders: confirmation bias. Confirmation bias is when you only pay attention to information that agrees with your existing opinion and you ignore everything else. In trading, this might look like seeing a clear bearish signal on the chart, but because you already decided the market must go up, you dismiss the evidence. You search Twitter or news headlines for any reason that supports your bullish view while rejecting anything that contradicts it. This bias feels comfortable because it protects your ego. You don't have to admit you might be wrong, but it's deadly because the market doesn't care about your opinion. It only responds to price and probabilities. And that stubbornness, the refusal to admit we're wrong, is exactly what professional traders warn about. Listen to how Phil Godeker puts it.
Now let's talk about being stubborn for a minute. Why is it that we refuse to cut losses? Is it that sometimes we refuse to be wrong? Or has the research we've done on any particular stock made us so overly biased that we think the market is wrong and we are right? Or did we possibly take on too much size overnight on a low float stock that's opened dramatically against us? You know, there's numerous reasons we take losses in the market. You know, I think at the end of the day, our losses are they're basically our fault. I mean, sure, there can be unexpected news or events, but at the end of the day, I think it's our stubbornness that leads to some of our biggest losses.
Exactly. Confirmation bias makes you stubborn. It convinces you the market is wrong and you are right. And as Phil explains, that refusal to admit you might be wrong is often what turns a small mistake into a big painful loss. Now let's look at another classic trap: overconfidence bias. Overconfidence shows up when you start believing you're smarter than the market. Maybe you had a few winning trades in a row and suddenly you feel unstoppable. You increase your position size, ignore your stop loss, or break your own rules because you just know you're right. This is dangerous because markets are designed to humble traders. A small streak of wins can make you feel like a genius, but one bad trade with oversized risk can wipe out all those gains in minutes. Psychologists Daniel Kahneman and Amos Tversky showed that humans consistently overestimate their own skills and underestimate risk. In trading, this bias is multiplied because money is on the line and emotions run high. Think about this. How many times have you increased your trade size after a big win, only to give it all back on the very next trade? That wasn't strategy. That was overconfidence taking the wheel. And here's the science behind it. Trading coach David Paul explains how the chemistry of your own body can trick you into feeling invincible after a winning streak.
If you've got 100,000 rand in your account, you should not risk any more than 1 to 2% of that in any one trade. And that will keep you alive. But there's a big problem, because we have runs of good ones and runs of bad ones. Now, between your ears, there's a thing called the pituitary gland. And that pituitary gland pumps out muti, that pumps out all sorts of hormones into your bloodstream. And those hormones are actually responsible for every emotional state that you have. When you have one good trade, two good trades, three good trades, the pituitary gland is hard at work, okay? And it's pumping this muti into your bloodstream. And you change completely. What happens is that after a series of winning trades, we become euphoric. And if you look in the Oxford Dictionary, the definition of euphoria is invincible. So just be careful about euphoria.
That's the danger. That feeling of being invincible is not reality. It's just chemistry. Overconfidence isn't proof that you're in control. It's a sign that your biology is pushing you to take risks you wouldn't normally take. And if you let that feeling run your trading, the market will eventually teach you a painful lesson. Another bias that destroys traders is herd mentality. Herd mentality means you follow the crowd simply because everyone else is doing it. In trading, this usually happens when you see a sudden wave of hype. Social media, news headlines, chat rooms, everyone is screaming about the same stock, coin, or setup. Your brain tells you, if so many people are in, it must be right. So you jump in too, not because of your system, but because of fear of being left behind. This is how bubbles are created. Remember the dot-com boom, the meme stock frenzy, or crypto surges? Thousands of traders bought, not from logic, but because the herd was moving. And when the herd reversed, accounts were destroyed. The painful truth is, the crowd is usually late. By the time everyone is talking about it, the smart money is already exiting. And that's why professionals warn about blindly following the news and the crowd. Here's how Larry Williams explains it.
You really have to be careful what you read. I don't read the Wall Street Journal. First of all, a lot of times they report stories in the Wall Street Journal that are kind of a jinx. How good the company looks and the company falls apart. What I trade is what's right in front of me in my charts and the data that I look at. There are just so many stories, whether it's the Wall Street Journal or Forbes or any of the media, that get us off track of being a real long-term investor or even a short-term trader. So be careful what you read. There's a lot of stories out there that are, well, they're written for a purpose to get people like you and me to buy when we should be selling.
That's the point. The herd mentality feeds on headlines and hype. If you trade based on what everyone is saying, you're probably late. As Larry shows, the real edge comes from ignoring the noise and trusting your own charts and data. Now let's talk about FOMO, the fear of missing out. FOMO is that powerful urge to jump into a trade just because you see the market moving without you. You tell yourself, if I don't get in now, I'll miss the whole move. So you chase the price, usually entering too late, right before the pullback. This bias is everywhere in modern trading. Social media amplifies it. You see screenshots of profits, traders bragging about catching huge moves, and your brain screams, I need to be part of that. The problem is that FOMO rarely lines up with a solid plan. It's an emotional reaction to opportunity slipping away. And once you're in the trade, you often realize you broke your rules and regret it. As Tom Hugard, author of Best Loser Wins, points out, the market punishes impulse. The traders who succeed are not the ones who always catch every move, but the ones who can sit still and wait for their edge. FOMO feels like urgency, but it's really just impatience disguised as opportunity. And the only real cure for FOMO is learning to stay fully present, right here and now, instead of projecting into the past or the future, as David Paul explains.
I think the ability, and you've got to work at it, to be totally and utterly present as the market is moving up and down. I think that it becomes more difficult if you're a short-term trader. There, your present moment could be a 5-minute chart. And I work very hard at being present, to stay in this moment, not to look at the past moment or the next moment, but to ground myself in this moment. And people keep asking me, well, why do you do these courses if you're making so much money in the market? Okay, and the real answer, of course, is that sometimes when I'm on a stage speaking to a group of people that are positive, that I feel incredibly present. And when you're in the present moment, it's a very sexy place to be. This is a tip for all the short-term traders out there. If you're watching the clock, you're not in the right place to be a short-term trader. And if you're in the zone, time disappears.
That's the key. The antidote to FOMO isn't chasing harder. It's learning to ground yourself in the present. When you're truly in the moment, you don't feel the fear of missing out. You feel calm enough to wait for your edge. The last major bias we need to cover is loss aversion. Loss aversion is the tendency to fear losses more than we value gains. Studies show that losing $1 feels about twice as painful as winning $1 feels good. In trading, this bias can be deadly. It's the reason traders hold on to losers, telling themselves, "I'll sell when it gets back to my entry price." It's the reason they move stop losses further away instead of taking the hit. The brain desperately wants to avoid the pain of admitting a loss, even if that means making the loss much bigger. Think about it. How many times have you let a small red trade turn into a huge drawdown because you couldn't accept being wrong? That wasn't your system. That was loss aversion controlling your decisions. Mark Douglas explained that successful traders accept risk completely before entering a trade. They don't fight the possibility of loss because they know losses are part of the game. If you can't accept that, your emotions will always force you to break your rules. The market punishes denial, and the fastest way to protect your account is to learn to take small, planned losses without hesitation. And Phil Goodacre shows exactly how dangerous it becomes when we ignore that rule.
Stops are a must. I mean, we all have to use stops. Now, I personally rarely use hard stops, but I have mental stops on every position that I take. Basically, if something's breaking support or resistance, I usually just exit that trade. And I think most of us here need to have a mental idea in our head of where we're going to exit a trade, based on where it goes against us. How many of us here have ever been in a losing trade and we're down something small, maybe $5,000, and we think, I'm not going to cut it. I feel like this is going to be a winner, and we add to that trade. An hour later, we're down $20,000 to $30,000, and we think, wow, it's hard to, I can't cut it now. We hold it till the afternoon. Maybe tomorrow it gaps up. We're down $70,000, $80,000, $100,000, and we think, what the heck just happened? I could have cut that loss yesterday for $3,000, $4,000, $5,000. Now I've given up 10, maybe 20% of my year just by being stubborn. Think about how much more money we could make at the end of the year if we just stick to some simple rules and cut our losses at an appropriate place.
That's the reality. Phil's story shows how loss aversion can take a small cut and turn it into a massive wound. The only way to protect yourself is to predefine your exit and have the discipline to respect it every single time. But loss aversion is only one of many traps. Confirmation bias, overconfidence, herd mentality, FOMO, they all work the same way. They quietly hijack your decisions and make you believe you're being rational when you're not. So how do you fight back against these biases? The first step is awareness. You can't eliminate them, but you can recognize when they show up. A few practical tools can help. Use a checklist before every trade. Ask yourself, am I following my plan or am I acting on emotion? Write down both bullish and bearish scenarios before entering. This forces your brain to consider evidence on both sides, not just the one that feels comfortable. Keep a trading journal that doesn't just track numbers, but also records what you were thinking and feeling. Patterns will appear, and you'll start to see which bias is your personal trap. And here's your exercise for this week. Look back at 5 of your recent trades. For each one, ask yourself which bias was present. Was it confirmation bias, overconfidence, herd mentality, FOMO, or loss aversion? Write down a short note about how it showed up. Once you identify your most common bias, you'll know exactly where to focus your discipline. Remember, every trader has these mental blind spots. The difference is that average traders are ruled by them while professionals learn to recognize and manage them. The market will always tempt you to deceive yourself. But if you can step back, label the bias, and let logic take over, you move one step closer to consistency. And in the next module, we'll dive even deeper into one of the strongest forces in trading psychology: fear, loss aversion, and the paralysis problem. You'll see how fear not only makes you exit too early, but sometimes keeps you from taking trades at all. And more importantly, you'll learn how to break through that hesitation. Now we move into the next chapter: fear. Fear is one of the strongest forces in trading. It's not just about feeling nervous. Fear changes how your brain and body react under pressure. It is the force that makes traders freeze when they need to act. close winning trades too early, or hold losing trades far longer than planned. In this chapter, you will understand why fear creates paralysis, how loss aversion intensifies emotional reactions, and how these patterns quietly damage execution. By the end of this chapter, you will learn practical ways to reduce fear-driven behavior, regain control, and trade with greater clarity and confidence. Let's start by understanding what fear really is. Fear isn't just an emotion, it's biology. When you're about to take a trade, your brain can't always tell the difference between risking money and facing a real physical threat, so it triggers the same survival response. Your heart rate spikes, your breathing gets shallow, your muscles tighten, and most importantly, your brain shifts control from logic to survival. Scientists call this the fight or flight response. In the wild, it kept our ancestors alive. But in front of a trading screen, it works against us. That's why you sometimes freeze on the entry. Your body is treating the trade like danger. It's also why you panic when the price moves against you. Your system didn't change. Your chemistry did. Trading coach Brett Steenbarger often explains that fear narrows attention. Instead of seeing the full chart and following your plan, your brain locks onto the threat, every tick, every candle, and you lose perspective.
What are the situations that typically set you off? In trading, most of the problem behaviors are problems as the result of under control or over control. Under controlled behavior would be trading impulsively. I suddenly forget about my position limits and I'm trading much larger size than I should be. I'm suddenly not honoring my stops. I know I shouldn't be adding to a losing position, but I keep finding myself doing that. That's an under-controlled behavior. The opposite would be an over-controlled behavior. I'm so anxious I can't pull the trigger and make the trade. My system told me that I was supposed to go long in the morning, and I just sat there and watched the whole damn thing go up and up and up and up. That's an over-controlled behavior.
This kind of freeze, driven by fear or the need for control, is what keeps many traders from executing high-quality trades. Learning to manage it is part of becoming a professional, but fear doesn't work alone. If fear is the trigger, loss aversion is the fuel. Psychologists Daniel Kahneman and Amos Tversky discovered something fascinating. Losing $1 feels about twice as painful as gaining $1 feels good. In trading, that imbalance is deadly. It's why traders hold on to losers far too long, hoping the market will come back. It's why stop losses are moved further away instead of being respected. And it's why so many accounts bleed slowly, not from one big mistake, but from refusing to accept small, controlled losses. Think about it. How many times have you watched a small red trade turn into a disaster just because you couldn't stand clicking close? That wasn't your system failing. That was loss aversion tricking your brain into avoiding short-term pain, even if it meant long-term damage. Mark Douglas explained this perfectly. Professional traders accept risk completely before entering a trade. They don't fight losses, they embrace them as part of the business. The difference between an amateur and a pro often comes down to this single shift. Learning to treat a loss as data, not as personal failure. This fear of loss isn't just a theory. It's one of the most common emotional traps in trading. David Paul shares a powerful example of how refusing to take a small loss can turn into something much worse.
Losses are a massive thing, and psychologists have done an awful lot of work on how to handle losses, but getting rid of your losses fairly quickly and then adding to your winners. In trading, to make money, you've got to do what the average person can't do. And the average person, in fact, struggles to cut a loss. And the average person, in fact, struggles to add to winners. So they buy a share at £10, the share goes to £10.50, they snap at the 50p profit. They buy a share at £10, the darn thing goes to 9, it's going to turn. Give it another tick. And then it goes to 8, and then it goes to 7, And then they get this thing in the back of their mind, hey, we can get 2 for the price of 1 here. So they buy some more at 7, of course the damn thing falls to 5, and they're finished completely. There's 2 types of capital. One is your loot, and secondly is your emotional capital. And if you make a mistake like that, that can leave an enormous amount of psychological damage.
That's the real cost of loss aversion. Not just losing money, but losing the emotional strength to trade clearly. Professionals cut early. Amateurs freeze and suffer. And that freeze can show up at the worst possible time. Fear doesn't always make you reckless. Sometimes it does the opposite. It paralyzes you. You see the setup. You've done the analysis. Your rules say enter, but your hand refuses to click. This hesitation comes from the same survival system we talked about earlier. Your brain is trying to protect you from danger. In the wild, waiting a few extra seconds could save your life. In trading, those seconds usually cost you the trade. Many traders describe this moment as a physical block. Tight chest, sweaty palms, tunnel vision on the screen. And when they finally do enter, it's often late, turning a good setup into a bad one. The paralysis problem also shows up in exits. Instead of letting a winning trade run, fear whispers, take the profit before it disappears. So you close too early, only to watch the market hit your original target minutes later. Mark Douglas used to say that markets offer endless opportunities, but fear convinces you that every trade is the one. That pressure makes you freeze, because the weight of being wrong feels too heavy. Larry Williams, a seasoned trader and educator, explains that this pressure often comes from unprocessed stress, and if you can't handle it, you're more likely to react or freeze at the worst moments.
Do you have the right stuff to become a trader or an investor? Frankly, I doubt it. A dear friend of mine, Jim Irwin, was the first astronaut to drive a car on the moon. I asked Jim how he got selected to become an astronaut. What process did they go through? He said the big tests were on how much stress we could handle. And to learn to handle stress, they had to repeat the same function over and over. Things would change. They'd have to learn to respond to it. That's what traders do and investors do. We're always responding to something that we don't have a lot of control over, just like the astronauts. So if you don't handle stress well, if you get emotional, you respond too quickly, this is not for you. Pack up your computer, stop trading, you're going to lose money. I don't want that to happen to you. Or learn to handle stress, to stop, to think before you react. Most people that are not making money react too quickly. Instead of cooling off a little bit, thinking about it, they jump to conclusions. This is not a business where you want to jump to conclusions.
Trading isn't just about strategy. It's about staying calm when your instincts tell you to panic. Mastering that is what separates a frozen trader from a focused one. So, how do we fight back against fear? Well, here's the truth. You can't get rid of it completely. Fear is built into all of us, but you can manage it. And with the right tools, you can stop it from taking control of your trades. The first tool is simple. Predefine your risk. Before you even click the button, decide how much you're willing to lose. Where's your stop? How big is your position? If those answers are clear, fear has a lot less room to mess with you once you're inside the trade. Second, write a short entry plan. I'm not talking about a big checklist. Just 2 or 3 lines. Entry price, stop loss, target. That little note becomes your anchor. When nerves kick in, you've got something solid to follow instead of emotions. Third, trade small when fear is heavy. If you're paralyzed, cut the size. Half size, quarter size, whatever it takes to reduce the emotional weight. Smaller risk means calmer decisions, and calmer decisions build consistency. Fourth, reset your body. Fear isn't just in your head, it's in your chest, your breath, your muscles. Slow your breathing. Stand up. Step back from a screen for 30 seconds. As trading coach David Paul says, staying present is one of the most powerful tools we have. And finally, journal your emotions. Don't just write down numbers. Write how you felt before, during, and after each trade. Over time, you'll see the patterns. You'll notice what really triggers your fear. And once you see it, you can prepare for it. Fear will always knock on the door when you trade, But with these tools, you stop letting it drive the car, and you put logic back in control. Alright trader, here's your exercise for this week. For the next 5 trading days, before you take any position, I want you to write a short entry plan. Just 3 lines, where you'll enter, where you'll place your stop, and where you'll take profit. That's it. Now here's the key. Once the plan is written, you stick to it. No moving the stop just because it feels uncomfortable. No exiting too early just because your heart is racing. The plan is your shield against fear. At the end of the week, go back and review those notes. Ask yourself, did fear make me break my plan? Or did the plan help me stay calm and consistent? This simple exercise will show you in black and white how much power fear really has over your trading, and how much control you can take back with a little structure. Now we move into the next chapter, greed. Greed is one of the most dangerous forces in trading. It often appears after a winning streak, creating euphoria that pushes traders to chase trades that no longer meet their rules. In the moment, it feels justified. Over time, it quietly destroys consistency and erodes profits. In this chapter, you will understand why overtrading feels rewarding in the short term, but damages performance in the long run. You will also learn how emotional highs distort risk perception and decision-making. Most importantly, you will learn practical ways to recognize greed-driven behavior early, protect your profits, and maintain your edge. Let's start with a powerful emotion that can destroy traders: euphoria. Euphoria shows up after a few wins in a row. Suddenly you feel untouchable. You start believing you see the market more clearly than ever. You feel like you finally cracked the code. But here's the trap: that feeling doesn't come from better skills. It comes from chemicals in your brain. And when you're euphoric, risk disappears from your radar. You add more size because this one looks even better. You skip the checklist because I already know. You move your stop because it'll turn around. That's the illusion of control. The market hasn't changed. What changed was you. After a few winning trades in a row, many traders start to feel invincible. But that feeling can be a dangerous trap. Let's hear how David Paul explains what happens in your brain at that moment.
If you've got 100,000 rand in your account, you should not risk any more than 1 to 2% of that in any one trade. And that will keep you alive. But there's a big problem, because we have runs of good ones and runs of bad ones. Now, between your ears, there's a thing called the pituitary gland. And that pituitary gland pumps out muti, that pumps out all sorts of hormones into your bloodstream. And those hormones are actually responsible for every emotional state that you have. When you have 1 good trade, 2 good trades, 3 good trades, the pituitary gland is hard at work, okay? And it's pumping this muti into your bloodstream. And you change completely. What happens is that after a series of winning trades, we become euphoric. And if you look in the Oxford Dictionary, the definition of euphoria is invincible. So just be careful about euphoria.
Euphoria may feel like a reward for doing well, but in reality, it's often the first step toward overtrading and losing control. Let's explore how that impacts your consistency over time. Now, let's connect this to overtrading. Overtrading is what happens when you keep clicking even though your system isn't giving you a signal. It's that feeling of, I don't want to miss the next move. So you jump in again and again until the chart becomes a slot machine. Sometimes it shows up as revenge trading. You're angry after a loss and you want it back fast. Sometimes it shows up as chasing. You're excited after a win and you want more. Different emotions, same result. You're trading outside your plan. Think about it for a second. How many times have you told yourself, just one more trade, and that one more trade erased the progress of the whole day? Now, some traders ask, is greed the same as euphoria? Not exactly. They're related, but they're not the same. Greed is the hunger. It's that inner voice saying, don't stop now. One more trade, one more win. It pushes you to stretch beyond your rules. Euphoria is the high that often feeds that hunger. It's the rush you feel after a winning streak, the voice that says, I can't lose. And that feeling makes greed even stronger because it convinces you that wanting more is safe. So here's the difference. Green is the drive for more. Euphoria is the drug that makes that drive louder. And when both show up together, that's when overtrading usually begins. So how do you know when greed or euphoria is starting to take over? The signs are actually pretty clear if you pay attention. The first sign is rushing. You feel like the market is moving without you, and you just have to click now. The second sign is skipping your process. No checklist, no written plan, just I'll figure it out. And the third sign is size creep. After a win, you quietly add more, telling yourself it's safer. If you catch one of these, it's a warning. If you catch two, you're already in the danger zone. And if you see all three, you're not trading anymore, you're gambling. That's why pros use circuit breakers, simple rules that stop them before emotions take full control. It can be as basic as this: 2 losses in a row, step away for 20 minutes. 3 losses in a row, I'm done for the day. Or, if I give back half my gains, I stop and protect what's left. These rules may sound simple, but they save accounts. Because the truth is, traders rarely blow up from a single bad trade. They blow up from a chain reaction: greed, euphoria, and overtrading stacked together. So how do we fight back against greed and euphoria? The truth is, you can't erase them. Winning will always feel good. That rush of energy will always be there. But you can manage it. And with the right tools, you can stop it from turning into overtrading. The first tool is simple. Set a daily trade limit. Before you even start the session, decide how many trades you'll take. 3, 5, whatever fits your style. And once you hit that number, you stop. No, just one more. Second, create a give back rule. Decide in advance how much of your profits you're willing to risk giving back in one day. Maybe 30%, maybe 40%. If you hit that line, you close the platform. That way, a great morning doesn't turn into a disaster afternoon. Third, use a cooldown after a win. When you close a profitable trade, wait. 1 candle, 2 minutes, even a short walk. Don't let the high trick you into jumping right back in. Let the market prove there's another real setup. Fourth, lock your position size. After a big win, don't increase your size just because you feel confident. Keep it the same for the next few trades. Consistency in size protects you from what I call victory over confidence. And finally, journal the urges, not just entries and exits. Write down the exact moments you felt the itch to click again. Over time, you'll see the pattern. You'll know what triggers your overtrading. And once you see it, you can disarm it. Greed and euphoria will always show up. But with these guardrails, you stop them from running the show. You keep control, and your edge stays where it belongs, in discipline, not in emotion. And now, here's your exercise for this week. I want you to set 2 guardrails and follow them for 5 trading sessions. First guardrail, a maximum number of trades per day. Pick a number that feels realistic. Maybe 3, maybe 5. But once you hit that number, you're done. Second guardrail, a give back limit. Decide how much of your daily profit you're willing to risk giving back. For example, no more than 30 or 40%. If you hit that line, stop trading. At the end of each session, write down 3 things in your journal: how many trades you took, whether you respected your give back limit, and which emotion tried to push you into overtrading. Do this for 1 week. You'll notice something powerful: fewer bad trades, stronger discipline, and much more control over your state of mind. To reinforce this idea, Larry Williams shares why his most valuable trading tool is the one he writes himself.
Well, there's 3 books that I really highly recommend to you. The first would be, it's a fun read, called Confessions of a Stock Market Operator, supposedly a story about Jesse Livermore. But to really understand the markets and yourself, I would recommend a book called Zurich Axioms. It's been just a wealth of information about how markets work, how about our emotions, how we can handle ourselves better in the marketplace. That's really the best book I've ever read about being a long-term investor and thinker of the markets. But the very, very best book of them all is this one, the one you're going to write. This is my book where I put in my trades every day, so I see if I'm buying and selling. I can look back in my trade and say, oh, what did I do wrong here? What did I say? What was I thinking? Why did I take that trade? That's the best way you're going to become a good trader. Keep records. Look at your successes. Look at your failures. Learn from your successes and your failures. And ladies and gentlemen, that's the best book you'll ever read about the market.
Tracking your behavior on paper will give you more insight than any indicator. And like Larry said, the best trading book is the one you write yourself. Now we move into the next chapter: discipline, patience, and consistency. These are 3 qualities every successful trader develops over time. Discipline is not something you're born with. It is a skill that must be trained. Patience is not passive waiting. It is the ability to stay aligned with your rules under pressure. And consistency, not perfection, is what separates professionals from amateurs. In this chapter, you will understand why these qualities are psychological skills, not personality traits. You will see how they are built through repetition, structure, and self-awareness. By the end of this chapter, you will know how to start strengthening discipline, patience, and consistency in your own trading using a simple and practical exercise you can apply immediately. Let's start with one of the hardest lessons in trading: discipline. Discipline isn't about being perfect. It's about training yourself to follow the process, even when every emotion in you wants to do the opposite. Think of it like a muscle. If you don't use it, it stays weak. But every time you respect your stop, stick to your position size, or follow your checklist, that muscle gets stronger. It's what separates consistent traders from impulsive ones. Without it, no strategy survives. With it, even a simple plan can protect and grow your capital. A disciplined trader doesn't wake up wondering, do I feel like following my rules today? He just does it, because discipline has become part of who he is. Now here's a powerful take on this from David Paul, someone who has helped hundreds of traders build the mindset needed to succeed.
I think that you can build discipline in any field that you want to sort of work at. It takes repetition. I go to the gym every day. I have absolutely no idea why I go to the gym every day at 61, but nevertheless, it doesn't take any discipline for me to go to the gym every single day. And the great paradox, of course, is that when you've got discipline, you don't need it. So it just happens. You can build discipline relatively easily. And in some of the training courses I've done over the years, we have a discipline building exercise, which is all about gritting your teeth and following a trading system for about 30 trades. It takes about 30 trades to instill that discipline. And I'm reasonably disciplined in most things. There are certainly things that I need to work on, that's for sure. But I firmly believe that anybody can develop the discipline to be a consistently winning trader, but very few do.
Discipline isn't something you wait to feel. It's something you build. And once it becomes second nature, it turns into your greatest edge. If discipline is the muscle that keeps you on track, patience is the filter that decides when you should act. Patience sounds simple, but in trading, it's one of the toughest skills. Why? Because the market is always moving. Every candle tempts you. Every headline makes you feel like you're missing out. But here's the truth. You don't need to trade all the time. You only need to trade when your setup is really there. Warren Buffett calls it waiting for the fat pitch. In baseball, you don't swing at every ball. You wait for the one right in your zone. Trading works the same way. Alexander Elder explains exactly what happens when traders confuse the market with a game, and why that mindset leads to failure.
I think market psychology is divided really into 2 huge areas: individual psychology of trader and mass psychology of the markets. In terms of individual psychology of traders, I think that all of us come to the markets with a wonderful goal to make more money than we can get from a treasury bill. But along the way, most of us lose focus and we start trading for entertainment. I think that financial markets are the most entertaining places on the face of this earth. It's like a horse race, card game, chess game, all rolled up in one, and it goes 24/7. You can always find action. And so people who are bored, stressed, hate their lives, they escaped into trading, and they're immensely entertained by it, but they don't make money. When you want to be entertained, you have to pay. You cannot make money. Successful trading is a little bit boring. And that's why my best advice for somebody who wants to become a cool, calm, disciplined, successful trader is keep written records. I hate keeping written records. I'm bored by written records, but that's what makes me into a serious trader.
Patience means resisting the urge to chase action. Serious traders know that boredom is not the enemy. It's actually a sign you're on the right track. And here's where it all comes together. Discipline gives you control. Patience keeps you from forcing trades. But it's consistency that transforms both into real results. Anyone can follow rules for a day or a week. The challenge is doing it trade after trade, month after month. That's what allows your edge to actually show up. Remember this, no single trade defines you. What matters is the series of trades. If your system has an edge, consistency is what lets that edge play out over time. But if you keep changing your rules or breaking discipline, you'll never see the benefit. Mark Douglas used to say, "The market looks random in the short term, but consistent behavior creates consistent results in the long term." That's the secret. Not the hottest indicator, not the news headline, but the ability to execute with consistency. So how do you know when discipline, patience, or consistency is starting to slip? The signs are actually pretty clear, if you pay attention. The first sign is bending rules. You move a stop, you take an entry that doesn't quite fit, you convince yourself this one's close enough. The second sign is forcing trades. Instead of waiting for your setup, you trade just to be in the market. That's impatience talking. And the third sign is inconsistency. One day you follow your checklist, the next day you trade on gut feeling. If you catch one of these, it's a warning. If you catch two, you're already off track. And if you see all three, you're not trading your system anymore. The system has lost you. That's why pros build circuit breakers. Simple rules that pull them back to structure before emotions take over. It can be as basic as this. If my setup isn't clear, I wait. If I break one checklist rule, I stop and reset. If I can't trade with calm size, I reduce until I can. These rules may sound simple, but they protect accounts. Because the truth is, traders don't fail from one single mistake. They fail from a chain reaction, broken discipline, impatience, and inconsistency stacked together. So, how do we fight back when discipline slips, patience runs out, or consistency breaks? The truth is, you can't erase those impulses completely. The urge to act fast, to skip steps, or to change your rules will always be there. But you can manage them. And with the right tools, you can stop them from taking over your trading. The first tool is simple. Use a pre-trade checklist. At minimum, write down 3 conditions that must be met before you enter. If one is missing, you don't trade. No exceptions. Second, apply a cool-down rule. If you catch yourself forcing trades or bending rules, step back. Even 5 minutes away from the screen can reset your focus before you make a mistake. Third, keep your size consistent. Don't increase position size just because you feel confident. And don't slash it randomly after one loss. Stability in size is what lets your edge play out over time. Fourth, commit to journaling behavior, not just numbers. Write down when you felt impatient, when you were tempted to skip a rule, or when you traded without full conviction. Those notes will show you exactly where consistency breaks. And finally, set a reset trigger. For example, if I break my own rules twice in a session, I stop trading for the day. This prevents a small slip from turning into a chain reaction. Discipline, patience, and consistency will always be tested. But with these guardrails, you keep control. You trade your plan, not your impulses. And that's what puts you on the path of professionals. All right, trader, here's your exercise for this week. I want you to build a simple pre-trade checklist and stick to it for the next 5 trading sessions. Here's how it works. First, write down at least 3 non-negotiable conditions for every trade. For example, the setup has to be clear on your chosen time frame. Your stop loss and target have to be defined before you enter. And the market conditions have to match your strategy. Second, before you take any trade, read that checklist out loud and tick each box. If even one condition is missing, you don't trade. No exceptions. At the end of each session, go back and review your trades. Did you follow the checklist every time? Did patience keep you out of weak setups? Did consistency show up in your decisions? Do this for just 1 week and you'll see something powerful. Fewer forced trades, stronger discipline, and a lot more control over your state of mind. This concludes part 1 of the Trading Psychology course. In this first part, you built the foundation by understanding how the mind works, how emotions interfere with execution, and how discipline, patience, and consistency are developed over time. In part 2, we continue building this framework by focusing on trader identity, risk and reward, emotional management of losses, routine, preparation, and journaling. When part 2 is available, you will find it linked in the card on this video. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.